Welcome to the Roy Matlock Jr. Money and Business Hour. Reach Roy at 615-843-2999 or visit roymatlockjr.com. And now, here's Roy.
Roy Matlock Jr. here, and today is going to be a show strictly devoted to the defense, and the defense is protecting your income and your assets, and it's going to be the insurance checkup. And we spend lots of money, and when I say a lot of money, I think it's about 6% of your income is going to different types of insurance. And you might as well, if you're going to be paying for insurance, you should know how it works and why it exists and things like that. And so if you think about an insurance policy, what it's going to do, it's either going to protect your income, your assets, your health, retirement, future lifestyle, all that kind of stuff. And so today, when you are listening in, if you would like to get a full review, because I'm going to show you how to improve your coverages and at the same time free up money to invest. And what that will allow you to do is to become all the time more self-insured. And when you become more self-insured, there's a lot of reasons to do that. The biggest reason is this, that if you take on the risk, that money that comes to you, you can invest that money because you have prepared to be able to take on risk. And then you're not paying the insurance company the money that they have to pay for the big buildings, and they pay for the employees, and they have to, do premium collections and all those kind of things that they have to do. What you're doing is you're taking on some of the risk, and in turn, you're able to, take that risk that you took on and put it into an investment and save some money. So today is about learning how to manage your insurance risk. But insurance, here's what it does. We transfer risk. I meet with people all the time, and they have their house paid for. And I always ask them, do you have homeowners insurance? And they're, of course, they do, because they are not willing to take the risk of their house burning down, even though the risk, if you think back in your lifetime of someone you personally know that their house burned down, it might be one or two people that you can actually say, I personally knew that had something like that, but people are unwilling to take that risk. So they transfer the risk over to an insurance company. But one major financial event can devastate somebody. So if you owned a house and it wasn't insured, that could be devastating. And so people own policies, but they very seldom have what I call a complete insurance plan. So some of the personal risks that are included, death, if you are an income machine, I always tell people this, that, we are an income machine. That's what we do. And we make deposits maybe twice a month. And I use the example, if you woke up every morning and you looked on the counter and there was a toaster oven, in that toaster oven, you looked at the toaster and there was, $3,000 in the little toaster. You reached over there and got it. And then 2 weeks later, there were $3,000 more in that toaster, and you went over there and got it. And after a while, you're like, wow, I've got a magic toaster. Every 2 weeks, there's $3,000 coming out of this toaster. I always ask people, would you do anything to protect it? Would you probably lock it up somewhere? You wouldn't just let it sit. So you would insure it. You would do whatever you would. And you are in the event of life insurance. A life insurance policy, it protects the toaster, you being the toaster that produces the income. And so all these things go into it, or you could become disabled. I think in many cases, being disabled could be worse than dying, because you are in a position where you can't take care of yourself and you're there. So we buy disability insurance. We could get sued. And so we buy liability insurance. All right. We could have accidents that damage property or our own property. We have illness, meaning sickness, or maybe we have, a scenario where we're in a long-term care facility. So the whole goal is to get to a point where you're self-insured, and self-insured allows you to take on part of the risk of insurance. So here's the thing about it. I've never yet seen anyone get excited about the premium payments that come out of their check every month. I've never seen it. All right. Nobody likes to do that. It's just like taxes. I ask people, what's your biggest bill? And in many cases, they say, well, it's my house payment. I said, nah, it doesn't look like that. Based on what you're telling me, your biggest bill is your taxes. And one of your other biggest bills might be your insurance. If you look at what's going on with healthcare, I mean, unbelievable. I had a client that, left a job, and we looked at what the company had been providing, and the premium to replace that was $2,500 a month, all right, to be able to get health insurance. And so what happens is we buy insurance to keep risk out. Retirement risk include market volatility, healthcare costs, or maybe outliving your money. So we look at buying an annuity. An annuity guarantees you lifetime income. Or maybe you're worried about the nursing home. You can buy insurance for nursing home. Okay, in the event that you have a long-term care situation, you could live to like my mother did. She lived all the way to 102, just passed away. You would not want to be outliving your money and running out of retirement money when you're 85. And then what are you going to do until then? And so what we do is we buy stocks and invest in stocks in order to get growth. We buy insurance to protect ourselves. And annuities are for income. Planning it all together kind of puts it in place. And so what we do is we buy insurance products, but in many cases, people are buying the insurance and they don't complement each other. In some cases, they compete with each other. In some cases, you're paying for two things that you can only collect on one, because insurance, the way it works is insurance is an indemnification agreement with an insurance company. What is indemnifying? It means bringing you back to the same. So you can't make a profit on insurance. If you end up making a profit on insurance, it's called insurance fraud. And so what happens is that you are out there buying, handing over premiums in order to be able to protect yourself. It's not designed to make you rich. It's designed to keep it an event from making you poor. My name's Roy Matlock Jr. If you would like to get a full insurance review, you can go to roymatlockjr.com and click Review My Insurance. And we handle everything that involves protecting you, your income, and your assets. We're going to talk insurance the rest of this hour. Stick with me. We'll be right back. All right, we are back. Roy Matlock Jr. here. Today's show, we're talking about a complete review of your insurance. And, I had one of our clients just this last week was able to review their insurance, just their home and auto, and it saved them, including all their liability coverage, $125 a month. And so what we would do with that is we would say, well, let's take $125 a month and invest that money. That's about $1,500 a year. $1,500 a year, rule of thumb over a 10-year period. Whatever you invest will double if you haven't invested. So that one little idea, if you take that difference and put it away, that could be a $30,000 10-year savings, and then it continues to compound and stuff like that. And so what we're doing today is talking about how to become self-insured. I'm kind of doing a little bit of a review right now on the different types of insurance that people are buying. I'm going to do some explanations and some things you may or may understand or may not, but with the idea that we're going to get you, when the show is over, you can review this on the podcast. We will have a insurance plan in place that will not only give you better coverage, but it will cut your cost. How about that? And so that's the idea. Why, if you're going to be putting money aside, you want to do this. You want to make sure that if a claim happens, you're not saying, is it going to pay? And so we have that, and then we want to do it and not duplicate and things like that. And this is part of some of the things that we do. I mentioned on the air that we have new advisor opportunities. So if you'd like to become a financial advisor as a sideline, you can get involved with us. And inside of our training system is we have our personal finance training. And we teach personal finance to our advisors first because we believe they get their own personal finances under control. That's the best way to talk to a client. And we teach you how to help others get their personal finance in order. And so if you are interested in something like that as a side gig, maybe a career change, go to roymatlockjr.com. today I would encourage you to check the insurance reviews out. And so let's talk about it. So now let's look at auto, home, liability, and health insurance. So auto insurance covers uh, liability. Liability is if you were to hit somebody and hurt that person. Okay. If you were to rear end someone, they may have medical bills, and as a result, you would be responsible for that. All right. So if they have 60,000 in injuries and you have 25,000 of liability coverage, you could owe the remaining 35,000. Okay. There's a maximum that all insureds will be paid. That would be the second number. It's so if you have a policy that says 25, 50, 25, the 50 would be the bodily injury for all people included in that. So let's say you have two people in the car and you hurt them, you run into the back of them, whatever it may be, and you injure three people. Their medical bills might be 80 grand, which would be easy to do. Your policy max out at 30 or at 50, and you would owe 30, and they could take that and garnish your wages and things like that. The last number on car insurance, when it says 25, 50, 25, is damage you cause to someone else's car, their fence or building, their mailbox, whatever it may be. So today, if you have the minimum state required coverage of 25, 50, 25, you could easily hit a car that's worth $100,000 or $50,000, and you would owe the difference. And let me tell you how this works. So the insurance companies, what they're going to do is they're going to say, okay, we're on the hook for 25, 50, 25. And the claim is the first person, any one person, here's one of them, it's 30,000. Another one is 30. Another one. All right. Car's messed up. All right. We're going to cut the check 25, 50, 25. Thank you. Appreciate it. You're on your own. All right. Then you get sued. All right. And you get to go hire an attorney. And these attorneys, when you get sued, you have to pay them in order to protect you. If you are suing somebody, you can generally get a personal injury attorney to take it on contingency. And what that means is they'll take it and, take a percentage of what they collect. But if you're getting sued, it's exactly opposite. The lawyers are not trying to get money. They're trying to save you money. But at the same time, if you are getting sued, you have to pay them to protect you. And so the legal fees could, run up to no telling depending on what happens. So a serious accident could cost $250,000 to $1 million. If you hit somebody and you really hurt them, if you kill somebody, it's even worse if it was your fault. It might be $1 million claim. So what happens is if you don't look at your coverages, and if you just buy the minimums, and you would buy the minimums because you call in somewhere and you don't have anyone that's actually doing an analysis of you to be able to do the right thing. So when I meet with people, the first thing I'm going to do is, I have a property and casualty license. We outsource that. It's a business in itself, but I do understand it. I got my license probably 20 something years ago, maybe 30 years ago. And I understand it because I see this stuff happening all the time. We had storms in Nashville and people were unprepared. And the questions that a lot of people had, does it cover the trees falling on my house? And what does it cover? What does it not cover? Does it give me, what I didn't have any electricity? Will it pay for my hotel? What is all these different things? And if you don't have an insurance agent that actually does an analysis and makes sure and looks at your comprehensive financial plan, then at that point, you could be in a situation that you don't even know. And I call it walking in the martial arts, they call it the white zone. And the white zone is where your danger is all around you, but you're just unaware of it and nothing bad has ever happened. All right. So we always teach in the martial arts to be in the yellow zone. The yellow zone is just to be very cautious. Look around at your surroundings. Don't have your back to the front door, all these different things like that. Well, when it comes to insurance, you don't want to be in the white zone of, nothing's ever happened, whatever. So we go in there. So we look at liability coverage. We look at collision, comprehensive. We also have uninsured motors. So if somebody hits you and they have no insurance, all right, and hurts you, then your insurance will be brought in to pay for your damages and so on. So, what better liability discussion should start in today's world at a minimum 100, 300, 100 instead of 25, 50, 25, which is the minimum state. And even better than that, you might go 250, 500, and 500 or 250, 500, 250. So those are the kind of things that we do. We also look at what is called personal umbrella policies. A personal umbrella policy is it's a policy that would cover you for personal liability, and it would cover you in your cars. It would cover you for your home and different things like that, and a lot of other things that go on where you might get sued for personal negligence and so on. Let me give you an example. Somebody comes over to your house and they get hurt. All right. And what do you do? All right. You are liable for that. All right. And trust me, there's plenty of plenty of personal injury attorneys. All you have to do is drive up and down the interstate and look at the billboards, and the billboards are personal injury attorneys that will be happy to sue you. And so, what we want to do is get the right coverages in place. So, what are we going to do when it comes to the insurance on your home and auto? We're going to up the liabilities, probably on your home and auto, do things to make sure that we have maybe $1 million or more of umbrella coverage, and that gets you in a good position there. We want to look at replacement costs is different from market value. We can talk about that. You want to be thinking in advance, and you look at insurance, as much as you hate paying the premium, the worst thing is paying a premium and it doesn't cover you, and then you're out a bunch of money. So if you're listening right now, a couple of ideas, go to roymatlockjr.com. You can get a full insurance review. We're going to be talking about annuities later. We're going to be talking about term life insurance and all the different insurances. So anything insurance, go to roymatlockjr.com and get a free review. Thanks for listening. We got 2 more segments coming. All right, we're in segment 3, and today is your insurance checkup. And if you haven't reached in and read your insurance policies recently, I would say you're like most people. I remember years ago that when I was doing radio with Dave Ramsey and we would talk insurance, and one of the guys that came on, Jerry House, he made a comment. He says, Roy Matlock sits at home on Saturday night and reads insurance policies. And I'm like, well, Jerry, you're not that far off, because I actually have read no telling how many hundreds, if not thousands, of insurance policies. And it's pretty funny when you read them. You're saying, you mean to tell me that if I have an accidental death and I don't die within 90 to 180 days of the accident, it's not considered an accident and it's not going to pay double? All right. Oh my goodness. I would be kind of a little bit concerned that on the 179th day, somebody may finish me off, to get double the coverage. I mean, that's kind of crazy, but the whole point being is most people, they buy accidental death and they don't even know why they buy it. They don't even know how it pays. They think they're going to die by accident. So you mean that if I walk to the mailbox and have a heart attack on the way to get the mail, that I'm going to get one number, but if I actually step in the street and get hit, I'm going to get another number? That doesn't change the number my family needed. I mean, the way I go has nothing to do with the way the need that my family might have. And so there's all these different things when you buy health insurance. People are used to, if they go to work for a big company, companies look at things like this. They say, well, we can provide benefits, and that's a lot. That's very sellable. Yeah, our company provides full health benefits. You can spend $20 if you go to the doctor and you're like, I like that. That's great. My kids go to the doctor, all this kind of stuff. And what you don't realize is that company is spending $2,500 a month for your coverage. Now, they take that as a business expense. And then what happens is that's just part of the overall pay package. Now, if you had a chance or a choice, you might say, well, rather than putting $2,500 a month, I would rather get a health share program and you give me the cash, and then the difference that I'm going to save, which is probably 50% on my coverage, I can use it for something else. All right. So there's all these different things that are out there. So when we're buying health insurance, I've always said, save your money, get an emergency fund, and raise your deductibles. Pay cash. And one of the ways you can do that is called a health sharing plan. And what happens is it's like getting a cash discount. You say, well, how does that really work? I'll give you an example, two examples. And I'm going to go back in time. I have a daughter that's 34 years old today. So 34 years ago, I was self-employed and having to buy my own insurance. And what I found is that back then, you actually had a rider that you paid that would cover pregnancy. Now, your health insurance would cover complications of pregnancy, but not the actual labor delivery. And so I looked at it and I was like, hang on a second. They're going to charge me X number of dollars per month extra, and they know the only person that's going to buy that rider is somebody that's thinking about having kids. Otherwise, I mean, if you're 60 years old, you're probably not going to add the rider for pregnancy, at labor and delivery. So I looked at it and I was like, all right, I called the hospital, and I kind of, I'm a planner. That's what I do. I plan money. I'm playing golf today. All right, when I get done, I'm going to play golf, and I plan my golf round. There's things I pay attention to, and so the started looking at it, and I found out that they would give me a 75% discount on labor and delivery. And I'm like, really? If I pay cash in advance? Okay, that'll work. Got a 75% discount. I went and had the insurance to cover complications, but I got a 75% discount on labor and delivery, which is one of the big costs of it. So I did that. I went in to get an MRI on my hand, and it was going to be $1,700, but the cash price was $450. So that allowed me to not go into the deductible. Okay. So as a result, I had high deductibles, paid cash, took the difference, and invested it. That's how I've always operated. And so when we're out there looking, if you're self-employed, and especially if you're paying for coverage for your employees, a health share is a very affordable, better way of doing things. I've been doing similar things like that. And then if you have a high deductible, you can do what is called an HSA. An HSA, you can put up to $8,600 this year if you're married into a health savings account. We set those up and we can put those into investments. You get a tax deduction on it. And if you pull it out, you don't pay taxes to use for medical expenses. So let's think about this. So you put 1,000 in. If you're in the 25% tax bracket, you get $250 back. If you spend the 1,000, you don't have to pay back the $250. Now, if we put that in and you don't have claims, and the account is into, say, a managed account where it's growing, then one day it starts building up. And if you don't use it, once you reach 59 and a half, it's treated like a Roth IRA, and you can use it for whatever you want, never have to pay taxes on it. Because that's what is called a health savings account. So what we do is we go in and we start thinking through all of this, and it's not unusual for me to see people, do reviews on their life, their disability, their health, their auto, their home, and all the different things to go along with it, and save $300, $400, $500 a month. And we take that $300, $400, $500 a month and put it into an investment. And that investment, depending on, maybe it's a health savings account, whatever it may be, that's a tax deduction, or maybe it's a Roth IRA, or maybe it allows you, because you freed up money, to contribute more to retirement plans, like if you're self-employed, whatever it may be. But the goal is to be more self-insured always. Here's why. We don't want to be adding extra cash to insurance companies for them to pay their big buildings, all their overhead, make a profit, when we could take part of the risk ourselves. And by doing that, we're able to take that savings and invest the difference. And I've been doing this forever. I mean, I had back in the early days, one of the things that we had the radio show, it was called The Money Game. Dave Ramsey and I started that show together, and it was in the early 90s. And one of the things we always told people was never buy a new car. We were, it's like, why are you going to buy a new car? And to this day, I've got plenty of money to be able to buy a new car. I always buy a used car. All right. And it's a good new car or a good used car, but it's not a new car. I'll let somebody else pay the depreciation. It's just in me. I don't know. I've been always doing that. And so, one of the things that we would tell people is, buy used and pay cash. We called them a money game car. We actually had bumper stickers. Don't laugh, it's paid for. It's a money game car kind of deal. And then what would happen is if you had an old car, you probably didn't buy collision insurance on it. All right. You would buy liability if you hit somebody. But the way you look at it, if somebody runs into my old car, then, whatever, it's not that big a deal. One of my reps, this is 30 years ago, he bought a car for $750. Now, when I tell you the whole story about it, he had car payments, credit card payments. And I told him, I said, dude, you're broke. How are you going to teach people how to do stuff? And so he and his wife sold their house, paid off their debts, bought 2 junkers, and he was parked in the parking lot here locally at Hickory Hollow Mall. And somebody ran into the side of his $750 car. He came back out, and there was a note on there. Hey, sorry, here's my name and number, and so on. And, I backed into your car, let my insurance company know, all that kind of stuff. Anyway, they gave him $1,250 for his car that he paid $750 for, and he had no insurance on it anyway, because he's like, hey, it doesn't matter. Stuff like that. I can tell story after story after story about getting things under control. And that's what we do. We're a financial advisory firm. We help you get control and implement financial plans. You can go to roymatlockjr.com. Today, we're talking insurance review. Go there and get an insurance review. We'll help you move forward. We'll be right back. All right. If you're tuning in, Roy Matlock Jr. here. We are doing a insurance checkup, and this would be a great podcast review if you want to go to the Roy Matlock Jr. Money and Business Hour podcast. Every one of our shows we put to podcast, and this is about saving money. It's about being protected. And what most people do when they buy any type of insurance, the first thing that they look at is the monthly premium. What does it cost? What you should be thinking about is, what is my deductible? What is my maximum out-of-pocket exposure? And what does it provide for me should I have a claim? That's what we look at. And so when we do an insurance review with someone, and it's just part of our overall financial planning appointment. So if I sit with someone, I have a system. And any of our advisors work this same system. System number 1 is education and advice. So what we're going to do is, my reasoning for being on the radio for all these years is because I always believe that if you became a client of mine, you'll be a much easier client to deal with if you know what's going on. I don't want you to come in and walk out and have no idea what you did, because then if the stock market goes down or whatever it may be, and you don't know about the plan, then you're not, for me, a good client. All right. Because then I'm having to deal with stuff that I shouldn't be having to deal with. So I get on the radio with a goal, and a lot of my clients that have been with me for many, many years, I'll be on an appointment with them, and they'll say, yeah, I was listening to you last weekend about this, and so on. And I'm like, good, that's what I want. I want to be able to give good advice and get people educated. And the more educated you are, the more you can accept the advice for what it is, and you end up doing better. The second part from that is we put together a plan. I call it the GPS, the goal, the plan, the schedule. And so we look for our financial independence number. What's the amount of money that you need to have to be able to quit and never worry about running out of money? And then once we get that GPS under control, we go into building the components. What is the first component? It's called the defense. The defense involves protecting your income and your assets. That's what I'm talking about today, is the defense, the insurance, okay, portion of what we do. Then we go to the offense. If I said, what are most of the offense? It's having to do with getting your money growing. It has to do with tax savings, things of that nature. And so then we go to a product marketplace, which we have as a fiduciary. I have access to everything investment, pretty much anything. We have multiple, when I say multiple, 30, 40 companies that we're able to shop insurance. And that could be your home, auto, your liability, everything that goes along with it, life, anything that goes along with it. We're not captive to any one company. And then we go out and we put together a plan. In some examples, I have clients that, even my sisters, that had one of them, because of one of them's one age and the other one's another age. They have different products because one company is a little more competitive at one age than the other, and so on. And so those are the kind of things that we do. Now, this last segment, we're going to talk about income protection. Life insurance is income protection. When you start out, the first thing you should always do is look at your income as a source that keeps everything going. So let's say that you were like me. I had 4 kids, 4 little kids. And if something had happened to me, the income breadwinner, then what would have happened is my family would have been, hurt in a big way. And until you have enough cash set aside that your working hours doesn't matter for the outcome of your income, you need to buy something to protect it. So what do? You buy life insurance. The number one, the place you start always is with term life insurance. Term pays only if you die. It does not build up a cash value. It's low cost with the intention you're buying it if you die. That's why you're buying it. Not for when you die, but if you die. So what happens, it would look like this. If I met with someone and they are making $100,000 a year and they had a mortgage and they owed $600,000 on their mortgage and they had 2 children, I would ask them a question. Right now you're living on $100,000 a year. If something happened, would you like for your family to continue to get your income if something happened to you? And they say yes. So I take a calculator. I actually have a chart, and I'll say, well, you're 35 years old. How much cash in a lump sum would we need if we invested it, say, at 8% to give the $100,000 a year with a little inflation bump every year for the next 30 years? And I come back and I look at it, 1.3 million, whatever that number is. And then would you like your mortgage paid off? That would take a load off. Yes. That's another 600. And would you like to have something that would fund your kids' college in the event something happened? Yes. That'll be 75,000 a piece. Well, whatever that number is. And we come up with a number and we go back, and interesting enough, most people for $100 or so a month, if they're healthy, they can generally get adequate term life insurance. If they're younger, if they're a little bit older, it might be $200 a month, and that will protect them up until, say, they retire. Then at that point, the term is going to renew. It's going to go up in cost, and you're probably going to drop it. And the reason you're going to drop it is that you have cash set aside. The idea, when you hit 67 or whatever year you're going to retire, you'll have your Social Security, you've got your investments, and that's what's going to be your income source. And I just had a client right now. He's just like right now. I mean, I'm talking like right now, they have both retired and they're getting from their investments their first checks. And so we set it up to where now they've got income coming in, so now they don't have to work. They plan. Now they've got it done. So we buy life insurance for that, term insurance. You may add some permanent life insurance to it. There's 2 types. One is called a universal life or indexed product, or what's called a variable life. I like variable life because it includes the index products too. But the long and short of it is that that's something you can keep. You can use it as an additional retirement plan. It's got benefits, and you can keep it all the way until death. People buy life insurance, permanent life insurance, with the idea that when they pass away, something will be paid to their family. There's also whole life insurance. I'm not a proponent of that. I've always said buy term, invest the difference, get, self-insured. But if you do want something that you want to keep, which a lot of people do, you've got different options that you can do that. You buy disability insurance. Disability insurance is to protect you in the event that you get disabled. It could be that you get disabled, not to the point you can't walk or move around, But maybe, as an example, you're a surgeon. I knew a surgeon that, he had did major surgeries, and he had to lean over, and he had back problems, and he couldn't do the surgery anymore. So he was able to get disability, but that didn't stop him from being able to work. It stopped him from being able to do what he was trained to do. So, he was trained to make a lot of money, but he couldn't do that. That doesn't mean he couldn't do something else, but you insure that's based on your occupation. And so it would typically pay you until you're 65. And then at that point, you'll pick up Social Security and your retirement. So what we do is we do things like this to keep ourselves from, getting knocked out, a wreck or anything like that. We go to annuities. Annuities are designed for retirement income protection. They create guaranteed income, and they work similar to a pension and Social Security. So if you retire, your Social Security will pay as long as you live. If you're married, you're guaranteed one of the two Social Securities after one person passes. So if you're both making $2,000 a month getting Social Security and one passes away, you just lost $2,000 a month. So at that point, you're going to want to maybe have something. If you don't have enough cash set aside, you're going to want to be able to put something in place that would allow you to have a continual lifetime income. So you could buy an annuity. An example of an annuity, somebody 65, 68 years old, something like that, you might be able to get a joint annuity that would pay 7% for the rest of your life, no matter what happens. Now, the goal when you buy an annuity is designed for you to run through all the money if you buy a guaranteed lifetime income. Now you say, well, why would I want to run through all the money? Well, the reason is that you live a long time, you outlive the money. That's what you want to do. If there's money left over because you didn't draw it as long, that means you died. We don't want to do that. And that means that money, though, would go to your beneficiary. So the idea is you buy annuities with the intention that you can have a guaranteed lifetime income. You can also use it for long-term care. There's annuities, for instance, that you put $100,000 in. It's getting a small interest rate. If you don't use it, whatever the annuity grew to, you would go to your beneficiaries. But if you happen to go into a nursing home or have any of the ADLs, activities of daily living, certain number of those, depending on the policy, it might pay 3 times that. And so what we do is we use annuities for that. We also use annuities to be able to take the risk of what we call market, bad markets, early in to your, when you first retire. So if we have down markets, sequence of return risk is what it's called. We don't want to be selling stocks when the market's down. So we buy an annuity to take a little of the pressure off of it. Then we use the investments for inflation protection. So you've got a bigger income opportunity with an annuity, and then you take the investments, and that can be later to supplement you for inflation. It also becomes for the sake of it, an inheritance account. And so we build all of this together. Annuities do not take care of everything. I hate this, but there's a lot of insurance people out there that they think annuities are the everything that you could ever need, and they're not. And so what we do is we couple annuities for people along with investment accounts. And in many cases, if you are in a really strong position financially, you may not have an annuity at all. You may just have your money. You're pulling small amounts off of your retirement plans, and you don't even need the annuity. And so these are things that we do. So then what we do when we sit with someone as an advisor, we analyze it all. That's what we do. We do an analysis of the defensive position, protect your income and assets, and the offensive position to grow, cut taxes, and be able to retire comfortably. My name is Roy Matlock Jr. 2 things you should look at roymatlockjr.com. Look at the insurance review. And also, we are expanding. If you've ever considered something different, a career change, come in and learn from us. We'll teach you how to become a financial advisor. Thanks for listening.